Welcome to Breaking News to Trade Moves. Today, we're looking at a specific U.S. policy announcement. We're going to examine its projected outcomes across, well, the industrial and commercial scene, based purely on the analysis that was shared with us.
Yeah, the focus today is pretty narrow. It's this new tariff action by the U.S. on imported heavy trucks. And this really gets into the whole logistics chain, impacting everyone from the truck manufacturers themselves down to the retailers using those trucks.
Okay, so the main thing to get our heads around first is the number. It's a 25% tariff, right? Specifically on imported heavy-duty trucks. That's a pretty big number. It definitely changes the math for anyone thinking about buying new commercial trucks from overseas.
It does. And it's worth noting the timing. This isn't happening tomorrow. That 25% tariff is actually scheduled to kick in on October 1, 2025.
October 2025. Okay, so there's some lead time.
There is. And it's important you understand the reasoning given for it. Officially, the goal is to protect domestic manufacturers. It's often presented as being about industrial self-sufficiency. Sometimes even national security is invoked.
Right, that framing matters. It suggests how policymakers are thinking about it. Maybe it's longevity. So our discussion then will really map out the expected results. We'll look at who might gain, pricing power or market share because of this protection, and then who in the logistics chain might face higher costs, more capital spending, more capex, and tougher competition because of it.
Exactly. Let's maybe place this in a slightly wider context first, though.
Yeah.
Because this 25% truck tariff, well, it didn't happen in a vacuum. The analysis we saw pointed out it was announced at the same time as new tariffs on imported furniture and branded drugs.
Okay. So while we're focused on trucks today, it sounds like this might be part of a broader trade strategy.
That seems to be the suggestion, yes. A multi-sector approach.
Okay, so given that, what does the analysis predict as the immediate market reaction, even before that October 2025 date? How are people expecting the competitive field to adjust?
Well, the consensus seems to point to two main things happening, sort of opposite sides of the same coin. First, you'd expect a strengthening position for U.S. original equipment manufacturers, the OEMs, and also their domestic suppliers, the ones feeding parts into those U.S. factories.
Okay, so the American truck makers and their parts guys.
Right. Being shielded from cheaper imports should give them more pricing power.
Pricing power meaning they can charge a bit more or at least hold prices steady because the foreign alternative just got 25% more expensive.
Precisely. That's the first expected outcome. The second is really the consequence for the users of these trucks. We're talking about the buyers, the big logistics firms, anyone running large fleets who might have relied on imported vehicles. They're expected to face higher capital costs, higher capex.
Right, because replacing or expanding their fleet just got more expensive if they were looking at imports. Or even if demand shifts heavily to domestic trucks, pushing those prices up too.
Exactly. It puts pressure on their spending budgets and potentially their operating costs down the line.
So it creates this clear split, doesn't it? Domestic producers potentially benefiting from less foreign competition, while the companies that use those trucks, the logistics operators, have to figure out how to deal with higher equipment costs, maybe tighter supply too.
That's the core tension, yeah. The domestic maker might win, but the domestic user of that equipment ends up footing a larger bill, at least initially.
Okay, that makes sense. Let's dig into the beneficiaries first then. Who does the analysis see coming out ahead in this new environment? It looks like three main groups.
That's right. First up, and most obviously, are the U.S. heavy truck manufacturers themselves, and also their dealer networks. The basic idea, as we said, is the competition shield. That 25% tariff makes imported trucks significantly less attractive on price. And this protection is expected to help the U.S. builders on several fronts, key metrics for their business.
Okay, let's break those down. It's more than just selling more units, right? It affects their actual business structure.
Definitely. First, pricing. It gives them a stronger floor, maybe lets them nudge prices up. Second, product mix. With less low-cost competition, maybe they can focus on selling more profitable, higher-margin truck models. And third, and this is quite important, it helps solidify the value of their existing order backlogs.
Explain that backlog point. That seems crucial.
Well, think about it. If a U.S. OEM, say, has an order for a truck at $180,000, and suddenly the equivalent imported truck jumps from maybe $180,000 to $225,000 because of this new tariff.
Then that existing $180,000 domestic order looks really good. The buyer isn't tempted to switch to an import that might have been competitive before.
Exactly. It makes that backlog much stickier. It basically compels fleet buyers who are always looking for cost efficiency to really lean towards domestic options to dodge that 25% hit.
And that naturally should lead to U.S. producers picking up market share that imports might have otherwise taken.
That's the projection. Now, the analysis names some specific companies here. First is PACCAR. They make the Peterbilt and Kenworth brands. Ticker is PCAR.
Right, well-known, premium brands, big players in the Class 8 heavy truck market.
Yeah, and this policy seems tailor-made to help them defend their position, maybe even expand it, especially in those higher value segments.
Yeah.
The tariff narrows the price gap between their premium trucks and potentially cheaper imports.
Okay, PACCAR, PCAR. And it also mentions the dealer networks benefiting. RUSHA Enterprises is named, ticker 3-AA. They're described as the largest U.S. Class 8 dealer network. Why the dealers specifically?
Well, the dealers are where the sales happen, right? So more demand for domestic trucks means more sales volume for them. But it's also about the whole life cycle. Dealers handle parts, service, and crucially, used trucks.
Ah, the used truck market. How does that play in?
If new trucks get more expensive, whether domestic or imported, it tends to lift the value of existing used trucks.
Okay.
So RUSHA's trade-in inventory could become more valuable. Plus, if fleets hold on to trucks longer because replacements are costly, that means more parts and service revenue for the dealers.
Got it. So higher new truck demand, potentially stronger used truck values, and more service revenue. Makes sense for 3-A. The third one listed here is Penske Automotive, specifically their commercial trucks division. Ticker PAGLIV. Sounds like a similar story to Rush.
Very similar logic, yes. Their business revolves around selling and servicing these heavy commercial vehicles. A stronger domestic manufacturing base protected by the tariff should mean more business flowing through their dealerships and service centers. Better pricing environment, potentially, too.
Okay, so that's the OEMs and dealers. The analysis then moves up the supply chain, right, to the component suppliers.
Exactly. The benefit doesn't just stop at the final assembly plant. It flows upstream to the companies making the key components, engines, transmissions, axles.
Because if more trucks are being built in North America to avoid the tariff,
Then you need more North American-made engines, transmissions, and drivetrains to go into those trucks.
Yeah.
It shifts the demand for those high-value parts towards domestic suppliers.
right, OEMs will want reliable, tariff-free component sources nearby to feed their increased production lines.
Absolutely. These are often very specialized, high-margin components, too.
Okay, who's highlighted here? First is Cummins, ticker CMI. They're huge in engines.
Yes, Cummins engines power a lot of trucks built by domestic OEMs, including PACCAR.
Hmm.
So if North American truck production overall goes up, Cummins naturally sees higher demand. Their volume is pretty directly linked to total truck builds in the region.
Makes sense for CMI. Then there's Allison Transmission, ticker WALSSN, focused on transmissions for heavy-duty vehicles.
Right, another critical part of the powertrain. Allison is a specialist. If the OEMs they supply are building more trucks domestically to capture that market share from imports, Allison should see a direct lift in orders for their transmissions. They get the volume boost without facing the import tariff themselves.
Okay, all LSN. And the third component name is Dana, ticker D-Day-Dane, axles and driveline parts.
Correct. Dana supplies essential bits that get the power from the engine to the wheels. Classic upstream supplier. This tariff helps their main customers, the U.S. truck makers, become more competitive.
Which means more demand for Dana's components to go into those domestically built trucks. So Dane benefits indirectly.
That's the projected link, yes.
Okay, OEMs, dealers, component suppliers. There's a third group of beneficiaries mentioned. This one's about raw materials.
Yeah, this is sometimes overlooked. If you're building more heavy trucks domestically, you need more raw materials, especially steel. Lots of steel.
Flat-rolled steel for the chassis, the frame, the body.
Exactly. Higher domestic truck production means higher demand for that steel. And the tariff sort of pushes manufacturing orders for those materials onshore, benefiting the domestic steel producers.
So by protecting the final product, the truck, you automatically pull demand for the inputs, like steel, towards domestic sources.
That's the idea. It's an indirect benefit. The analysis names major U.S. steel companies here. First is Nucor, ticker UEE.
Big domestic steel producer. More trucks being built here means more orders for Nucor. Seems straightforward.
And also Steel Dynamics, ticker STLD.
Okay, CSTLD. Similar logic. Both potentially gain from higher demand from the U.S. auto and truck manufacturing sector, which this tariff is expected to support by displacing imports.
Right, it creates that connection tariff on finished trucks, leads to more demand for domestic steel.
Okay, so we've mapped out the potential beneficiaries quite clearly. U.S. truck makers, dealers, key component suppliers, and steel producers. But like you said earlier, this cost has to land somewhere. So let's flip the coin. Who is expected to face pressure from these higher equipment costs?
This is where we look at the companies that have to absorb that price increase. The first group identified is what the analysis calls import-exposed fleet buyers and brokers. These are the big companies managing large fleets, often focused on sourcing equipment very efficiently, maybe globally. They get hit directly by higher purchase prices if they were relying on imported tractors.
But wait, couldn't they just switch completely to domestic trucks and avoid the tariff?
They can certainly try, and many will. But a couple things. Domestic OEMs might not be able to ramp up production instantly to meet all that shifted demand. There could be waiting lists, delays.
So potential supply bottlenecks, even for domestic trucks if demand surges.
It's possible. So the impact isn't just the 25% price tag on the import. It could also mean delays in getting any new truck. And for a large fleet operator, delays and higher cost put direct pressure on operating margins. It makes fleet replacement harder, potentially impacts shipping capacity if trucks age out faster than they can be replaced affordably.
Okay, that makes sense. Which companies are mentioned here? Ryder System is first, ticker $2. They manage and lease huge fleets.
Right. Ryder's whole business depends on acquiring vehicles cost-effectively. If a major source, imports, suddenly cost 25% more, or if domestic alternatives face delays and price hikes due to demand, it hits their capex budget hard. They either absorb that cost or have to pass it on in higher lease rates.
Okay, pressure on $3. Next is C.H. Robinson, ticker CHRW. They're a major freight broker, right? They don't own all the trucks themselves.
Correct. They connect shippers with carriers, but they rely on a healthy, cost-effective trucking market with plenty of available capacity. If the underlying cost for truck owners goes up because of equipment prices, that eventually feeds into the freight rates C.H. Robinson has to negotiate. Higher rates can squeeze their brokerage margins.
Got it. So even if they don't buy the trucks, the cost inflation in the truck market affects their business. That's CCHRW. And XPO is also listed here, ticker XPO, another big logistics provider.
Similar story to Ryder in some ways. Managing their own fleet assets efficiently is key. Higher capex for trucks, whether imported or domestic, introduces financial friction. They face that choice. Pay more, wait longer, or maybe sweat assets longer, which has its own costs. Pressure on XPO.
Okay, so the fleet owners and brokers are feeling the direct hit on equipment costs. But you mentioned this cost tends to filter down.
Yeah, it rarely stops there. The analysis suggests this equipment cost inflation is expected to work its way into freight rates over time.
Because the trucking companies, the Ryders and XBOs and smaller carriers, they can't just eat a permanent increase in their main capital costs. They have to try and pass it on.
Exactly. They need to recover those costs. So shippers eventually see higher prices for moving goods.
And that ultimately means higher fulfillment costs, higher last-mile delivery costs, which puts pressure on businesses that ship a lot of stuff.
Precisely. Especially businesses where low-cost, efficient shipping is absolutely core to their model.
Okay, who falls into that category? The analysis points to the big retailers and e-commerce players. Amazon is first, ticker AMZN.
Yeah, Amazon lives and breathes logistics optimization. Their scale is immense. Even a small, sustained increase in the cost per mile for trucking adds up to enormous sums across their network. It puts pressure directly on their fulfillment expenses.
You can see that. Hundreds of millions easily if freight rates firm up structurally. Okay, AMZN. And Walmart is also named, ticker WMT.
Same principle for Walmart. They operate vast logistics networks to stock stores and fulfill online orders. Controlling transportation costs is critical for their low-price model and profitability. Higher trucking costs mean higher costs of getting goods onto shelves or to doorsteps. Pressure on WMT.
Okay, so retailers feeling the pass-through effects. There's one more group mentioned facing pressure, equipment renters and construction fleets.
Right. Think about companies whose main business is buying heavy equipment, not just trucks, but potentially other gear, moved by trucks, and then renting it out. Their whole financial model depends on the return on investment, the ROI they get from that equipment. And ROI is very sensitive to the initial purchase price.
So if the cost of buying that equipment goes up, maybe partly due to tariffs or general trucking cost inflation impacting delivery?
It makes it harder to get the same return when they rent it out unless they can raise rental rates significantly, which isn't always easy in a competitive market.
Right. The higher purchase cost squeezes that ROI calculation.
Exactly. It makes replacing or expanding their rental fleet more expensive.
Which companies are highlighted here? United Rentals, ticker URI. They're huge in equipment rental.
Yes, they deal with a vast amount of heavy machinery.
Mm-hmm.
Tariff-related inflation hitting equipment costs or transport costs for that equipment strains their capex budget and potentially their returns on newly acquired assets. Impacts their fleet management strategy. So URI.
And Herc Holdings is also mentioned, ticker Lee HRI, another major player in that rental space.
Same logic applies to Herc. Their profitability is tied to buying equipment efficiently and renting it out effectively. Higher acquisition costs, driven partly by these broader tariff and logistics cost issues, make that balancing act more challenging and expensive. Pressure on HRI.
Okay, that paints a pretty clear picture of the two sides, the potential gainers from the protection, and those potentially facing higher costs or tighter margins. So let's try to summarize the main takeaways or angles from this analysis, just based on the information presented. What are the key directions suggested?
Well, one clear theme seems to be a focus on those domestically focused truck OEMs and their suppliers, the ones like PACCAR, PCAR, and Cummins, CMI, who look positioned to benefit from that tariff protection and might have more pricing power. Established backlogs are a plus there, too.
Right. And then there's the dealer angle,
Mhm.
focusing on dealers like Rush, the RUSHA, and Penske, PAG, who have strong new and used truck operations, but also benefit from that parts and service revenue, which might hold up well or even increase if fleets age a bit.
Exactly. That diversified revenue stream seems important. And finally, on the other side, it suggests keeping an eye on those big consumer-facing names that are really sensitive to shipping costs, like Amazon, AMZN, and Walmart, WMT.
Yeah.
The potential for margin pressure there if freight costs do rise due to tighter equipment supply or higher operating costs for carriers.
Yeah.
That seems to be a key consideration.
Yeah, it really shows how one policy change, like this truck tariff, can send effects through many different connected parts of the economy, from steel mills right down to online shopping costs.
It does illustrate that interconnectedness quite well. And look, before we wrap up, it's really important we state this clearly. Everything we've discussed is based purely on the analysis provided to us. It reflects the author's opinion. This isn't financial advice from us, definitely not a recommendation to buy or sell anything. It's purely for informational purposes, just to help you understand the perspective presented in that analysis.
Absolutely. Consider it context for understanding potential market dynamics. Well, thank you for joining us on Breaking News to Trading Moves. We'll leave you with a final thought to chew on. The analysis mentioned this truck tariff landed alongside others, including one on imported furniture. How might that furniture tariff layer onto the challenges facing retailers like Amazon and Walmart, who are already potentially dealing with higher trucking costs? Something to consider.